Coming up today, why bond yields are rising and causing a breakdown in market internal, a look at a new seasonal pattern, the South Park jinx, Salesforce dives on earnings, and the potential opportunity in commodities. Hey, what's up guys? Thank you for tuning in to the Click Capital Daily Market Review. I'm your host Jared, and I'm going to get you all up to scratch on everything that's happening across financial markets. And a big thanks to everyone who supports this channel by hitting that like button. And let's dive right in today. So my previous thoughts on the S&P 500 is that we were likely to consolidate and trade a little thick here. However, like I always say, you got to follow the tape. Technicals lead, fundamentals follow. And as a trader, I prefer to have loosely held theses opposed to closely held convictions. You'll find quite a lot of people come up with a theory or an idea and they fall in love with it and they get stuck on it and they kind of become blinded to a changing tape. And so now I'm thinking maybe this bearish engulfing candle could be starting to play out similar to the last couple of times we had the same pattern formation, and there's a few reasons for that. We gapped down today, which in itself is a bit of a bearish signal after we closed lower than when we opened. I can see my wave flow indicator here starting to compress again like it did at the start of April before turning red. And just looking at the bird's eye view of markets, now got the Russell 2000 underneath the 50-day, volatility, bond yields and oil, along with the dollar index and inflation expectations, pretty much green across the board, all above their moving averages. Even got the strong utility sector below the 20-day moving average, and a number of other key sectors like discretionary, industrials and financials below their medium-term 50-day average. It's really just Nvidia doing all the heavy lifting, having a bit of a halo effect throughout the semiconductor sector, and that's helping to hold up the growth versus value momentum and the S&P and Qs somewhat as well, as the S&P 500 is not looking too bad here on the chart. However, underneath the hood, breadth is breaking down somewhat. We can see that in the S&P 500 equal weight, having lost its 50-day VWAP today. And just looking at breadth, the percentage of S&P stocks above the 20-day average, it's actually been diving for 2 weeks now. Currently at 24%, got a little bit of a breakdown in another measure of market breadth, new highs versus new lows. On the NYSE today, coming in 28 new highs versus 67 new lows. That's spiking up a bit. However, what's really different today, and has got me thinking maybe we pull back a little deeper, is the spike in the VIX, volatility, and options pricing. As S&P 500 wasn't even down 1% today, however the VIX spiked over 10%, now climbing above 14, and like I'd been saying over the last couple of weeks, the market was offering up a good opportunity to add some VIX hedges, which I'd been doing in the form of VIX bullish call spreads, buying the 12 and 11 strikes, selling the 18 and 19 strikes, with expiries in July and August. Those spreads are starting to turn a profit now. However, I'm looking for a spike up to 18 and 19 as a good place to get out of those trades. Also got volatility risk premium climbing up as well. The amount option dealers are asking in implied volatility over realized. And I've just added in a new index to my monster watch list here called the Nation Skew Dex. And it's similar to the Skew Index that you guys know I've been covering quite some time now. However, the Skew Index is a more broad measure of out-of-the-money options versus at-the-money options, and it's better for a long-term measurement of where the option market is pricing risk. The Nation Skew Dex is better for a short-term look at where the options market is pricing risk, and basically that's just 30-day out-of-the-money puts versus at-the-money puts, and that's been climbing steadily over the last 2 weeks, meaning the price of out-of-the-money puts is climbing a lot steadily versus at-the-money. And if I just turn this into a clean chart, take off the indicators and invert it upside down, then go ahead and overlay that with the S&P 500 here in the orange line, you'll see there is a bit of a correlation there, especially in the last time the S&P 500 sold off from late March going into the 19th of April. That correlated well with the spike in the Skew Dex as well. Just looking over here, it went from 47 down to 57, and so I've got this similar pattern while the S&P 500 is still holding up, causing a bit of divergence there, and that's thanks to this guy right here, the star of the show, Nvidia, and a very weak bearish tape today. Every single stock sector finished down, even semiconductors as a sector finished down 1.67%. Even though Nvidia makes up almost a quarter of the fund's holdings, it still did its own thing and finished the day higher almost by 1%, showing you how exceptional this stock is trading. And you can imagine if we had a green tape today, what it would be doing. And so it looks like it's on a solid march to its 3 trillion market cap for the first time and could potentially overtake Apple and Microsoft in the days or weeks ahead of us. However, just going back to breadth for a second here, looking at short-term breadth, percentage stocks above the 20-day average at 24%, this still could have a little further to run, like we did in mid-April. Actually got down to 6% there and bottomed out on the 17th of April and actually shot up on the 19th of April. And what you'll often find is breadth leads the market because there's the 19th of April. It was actually a down day in the S&P 500, but breadth had already started moving higher. And so breadth actually bottomed here on the 17th, around that 6-8% level. And so maybe we could have a little bit further to fall on the S&P 500, especially if Nvidia takes a pause here. Just drawing a Fibonacci retracement on this latest move up from the 19th of April. 50% retracement would take us around 5150, which is also where the 50-day VWAP is. And that has been a level before where the market has made a few turns off. So I'm going to draw in a support box there with the possibility the S&P 500. Over the coming days, maybe next week, we could trade down to this 5150, 5170 level, where short-term breadth should also come down to single digits, where it typically finds a bottom as well. And we may just get a little bit more of a spike in the VIX, even if it only goes to 16 or maybe 17 if we have a sharp one-day move. At which point, I'd expect the market to find some support due to strong seasonality and really loose financial conditions backstopping this market. And what did spook the stock market, and most likely the VIX today, was climbing bond yields to a 4-week high after we got another weak treasury auction, which means the yield the government sold their bonds at was higher than they had hoped, and dealers having to take up more of the inventory to get the auction done. And the stock market really took note of that today. Like I said, all sectors closed lower. However, there could be good news around the corner. Bank of America did some research on the US government bond 10-year yield trend analysis. Going back to 1963, they found on average the 10-year bond yield actually trends up into May, where it typically peaks out for the year. However, taking it a step further and looking at the average trend for the year, when January's up, like it was this year, bond yields can actually climb all the way into September. A step further again, when January's up and we're in year 4 of the presidential election cycle, it can rip up hard like it has done this year. As of today, we're currently up about 70 basis points for the year on the 10-year. Can mean a lot of volatility. However, average trend says we may have already peaked 10-year bond yield. And I'd say Jay Powell and Janet Yellen certainly hope so as well. And taking a big step back and looking at the average 10-year government bond yield, going all the way back to 1791, back to the early days when the US bond market first started trading. Where we are now, here in the light blue line, is pretty much around a long-term average and is not really high in a historical context by any means. Similar for world yields as well, pretty similar path. But for the here and now, bond yields are definitely climbing back with some gusto. There's the 10-year at 461 and the 2-year just below 5%, and that's likely keeping a bit of pressure on the stock market here, which we can also see show up in S&P futures liquidity, which is basically a measure of how many contracts on average are available on the bid to sell and on the offer to buy, and that's taken a sharp spike down these last 2 weeks as well. And when liquidity is more sparse, that can exacerbate the moves in the market. As it wasn't too long ago, the market was trading really thick, plenty of liquidity. However, that's sharply changed. Like we can also see the change in the volatility market, not just the VIX and the skew index, the relative price of out of the money puts to at the money puts, but also in a sharp drop in call skew as well. It's the price of out of the money call options versus at the money call option, pulling back sharply along with that spike in put skew. So that's the here and now in the stock market, which we could be in for a little bit more weakness in the days or a week or so ahead. Just stepping out a little bit and looking at an interesting new chart coming out of Ned Davis Research. They created a cycle composite chart for the S&P 500 this year, in which they placed equal weight on the regular 1-year seasonal cycle, the 4-year presidential cycle, and the 10-year decennial cycle. So combining all those things together gives us this blue line here, which actually all combined creates for a pretty strong year, and actually suggests we could have a bit of weakness around this time of year. It normally says May's a down month, and then we bottom out in June. However, it's possible we may have already had that seasonal weakness when we had that pullback in April, in which case that would mean we would consolidate somewhat before finding a summer rally. Then getting that typical weakness consolidation we normally get around September and October before we go into that November-December rally. And so there's an old saying in the stock market, sell in May and go away. However, that's not really true in year 4 of the presidential election cycle, like we can see in this seasonal chart here. And looking from May to November, in the presidential election year, that period's actually positive about 78% of the time. And so my forecast is in line with this data as well. Like I said, we're likely to consolidate here. If not, maybe have a bit more of a pullback. I'd be surprised if the market took out 5,000. We could potentially dip down, fill this gap at 50.73. However, I'd expect that to be another good buy the dip opportunity. And looking back in history, the market should go on to take out these highs and potentially cross 5,500 before we hit Christmas. That is, of course, unless we get any real surprises, upsets or shocks, maybe unemployment spiking above 4.2% or some other geopolitical event. Anything can happen in the market. No stats are right 100% of the time. And so like we can see with the price action in Nvidia, it's really AI driving this market now. However, not everyone's so bullish and optimistic on it. We got one MIT economist saying AI will provide just a 1% GDP boost over the next decade, with that being a fraction of the impact being forecasted by the likes of Goldman Sachs, who are very bullish on AI's economic prospects, previously forecasting that annual global GDP will eventually see a 7% boost from AI's labor impact, whilst the MIT economist is more pessimistic as he doubts how much AI can really advance total factor productivity, and saying other things. Deep fakes, false advertising, social media addiction, and AI-led computer hacks could actually have an impact on welfare and may not be the economic boon we're all hoping for. And in addition to AI, one of the other hottest themes in markets over the last year or so being the new GLP-1 weight loss drugs, like Ozempic, taking the world by storm, sending makers of the drug, like Eli Lilly, and Novo Nordisk skyrocketing. Whilst on the other end of the spectrum, the high sugary snack makers have taken it on the chin. Some of those stocks down 20, 30, 40% over the last year or so. However, in true form, South Park has just done an episode with a storyline around these weight loss drugs and the companies that sell them. And looking back in history, 1 year after these companies appear on South Park, the median stock underperforms the S&P 500 by 7%. And that might sound a bit crazy, but it's not really. And it's not really anything to do specifically with South Park. It's more an indicator that a certain theme in the markets have become so prevalent that it's made it into mainstream, everyday talk of society, because that's what shows like South Park do. They want to make episodes about relevant issues, get people interested in talking. And like I said, this isn't just South Park. This is a pattern that's been going on for hundreds of years in markets with something called the magazine cover indicator. And just like South Park, when mainstream publications, media, magazines, big websites feature stories with big dramatic headlines, it's often an indicator the market is close to reaching its peak or bottom. Doesn't time it exactly down to the month. However, it's often pretty close, like one of the most famous ones being here. Back in 1979, the front cover of Business Week, the death of equities. After the 1970s was pretty much a lost decade for the stock market. It was actually not that far off from a generational bottom 2 years later. And you see it time and time again. 1999, GetRich.com, Home Sweet Home, 2005, Holding On for Dear Life, March 2009. That was actually the month the stock market bottomed out. And so it's basically just a sign that a certain theme or story has reached kind of a boiling point of how it's talked about in society. And so looking at a long-term clean monthly chart of Eli Lilly, who's benefited enormously from these weight loss drugs, I think it'd be fair to say we are closer to a top than a bottom, as the magazine cover indicator will rarely get you into something early. However, like I always say, you never know how crazy markets can get. This could still run up to 1,000 or even further before it eventually does top. And considering it's already on a price to earnings ratio of 120, it's pretty much priced for perfection and have to keep growing at breakneck speeds to even justify this valuation. Same deal with Novo Nordisk, although its valuation is not as bad with a PE of 46. However, one of the biggest bears out there, John Hussman, fund manager, says the S&P 500 could plunge as much as 70% in this cycle as the markets hit a motherload of FOMO extreme, pointing to his firm's most reliable indicator, now exceeding that of the 1929 extremes before the stock market tumbled 90% over the next 3 years. And this guy does have a bit of a track record. He predicted the 2000 and 2008 crashes, but he said this extreme run-up, driven by investor impatience and the fear of missing out, are the key ingredients for a coming correction. Going on to say there are certain features of valuation, investor psychology, and price behavior that tend to emerge when the fear of missing out becomes particularly extreme and the focus of speculation becomes particularly narrow. Last Friday, we hit a fresh motherload of these conditions. And bold claims indeed, but who knows? He could be right. I mean, it has happened before. Looking at the Nasdaq in 2000, global stock markets in 2008, that was 16 years ago since we had a really big correction in global equity markets. COVID pretty much looks like a blip on the chart. And I'd say it could be possible next year or in 2026, but in this current election year and seasonality, like I said, I think it would take a big surprise for us to get even anything greater than a 10% correction. But one thing's for sure, this market and the billionaires running it are flying as high as they've ever flew. Just 7 US tech billionaires have seen a 230 billion surge in wealth just this year alone on the back of the AI bull market. Steve Ballmer, former CEO of Microsoft and LA Clippers owner, has pretty much held onto all of his shares he was given as one of the first employees to join Microsoft back in the late 70s. Still owns 4% of the company. Why his net worth is 148 billion. Jeff Bezos, stock is up. Sergey Brin of Google, along with Larry Page, one of the highest flying stocks of the 90s, and man behind it as well, Michael Dell. Big resurgence, especially this year. Dell's up 117% year to date, adding 38 billion to his wealth. And there's a look at the monthly chart of Dell, up 43% just this month alone, coming back out of nowhere, now with a market cap of 127 billion. Coming in at number 2, Mark Zuckerberg, after his stock bounced back from the depths of 2022. And of course, the man of the hour, Jensen Huang, leading the pack. One billionaire not happy today is the man behind Salesforce, Mark Benioff. With this stock tumbling after hours as I speak, as they just reported earnings, with sales and bookings disappointing the market. Even though they reported revenue up 11% year over year. It was at the low end of the company's guidance range. Wall Street had been hoping for a little bit more. However, they're still buying back a lot of stock, 2.2 billion first quarter, and Wall Street overall still likes the stock, just undergoing a bit of pricing after hours, finishing the post-market session at $228 a share. And so like I just showed you in market breadth, it's actually decreased further today from this chart, with only about 36% of S&P stocks above their 50-day moving average, with energy, consumer stocks, industrials, and REITs having the worst breadth. What's the real standout is utilities. 77% of utility stocks trading above their 50-day moving averages, and we can see that in the price trend over the last couple of months. It's gone almost parabolic, having a bit of a pullback this week in line with the market. Be setting up for a buy the dip opportunity, as this has two benefits: not only a defensive trade with the dividend yield if the market does go sour, but also riding the AI boom and the huge demand for electricity now. And two of my favorite stocks in the sector, and have been for a while. NextEra Energy, with their focus on renewables, it's on a really strong uptrend here. Came in with a good beat on last earnings, and also the ever strong Vistra Corp. Been on an absolute tear and doesn't even appear to be pulling back with the overall sector here either. Also doing really well this year is a lot of commodities, with some saying now the next trade is to get in on the miners who have been underperforming the underlying commodities for a long time now, and that typically happens in commodity bear market like we've mostly had over the past 15 years. With one of the most hottest commodities this year, and likely to remain so going forward thanks to the electrification of the world, artificial intelligence, huge rise in data centers, even used in military weapons as well, is that of copper. And I think it would surprise a lot of people to know that, excluding China, for much of the past 15 years, the rest of the world had actually been decreasing their copper demand, pretty much China making up for all of it over the past 20 years. And China's coming back, and now the world's coming back to copper as well in a big way. And there's a look at the daily chart on copper. Had a bit of a pullback this last week. And there's a look at a long-term chart of copper from the late 90s, in which it found all-time highs this year, technically still looking good. And instead of buying copper companies individually and taking on company-specific risk, one way to play the copper boom is through the Global X Copper Miners ETF, COPEX. Reasonably sized with 2.5 billion assets under management, dividend yield of 1.79%, holds in total 41 stocks, and it's quite diversified. 47% of the fund in North America, 23% in Europe, 18% in Asia, and 8% down under as well. And there's a look at a long-term monthly spread chart of the Copper Miners ETF COPEX versus the underlying commodity, copper futures. And so we can see that's underperformed for a long time. However, now it's definitely back in an uptrend. It's actually pulled back these last couple of months. And so relative to the commodity, copper miners could present a good opportunity here as well. Just over to the economic calendar, we didn't get much out today. Crude oil inventories dropping much larger than expected. Tomorrow will be a bit more important. We get a look at US's GDP growth, and then the big one on Friday, core PCE price index, inflation data. Currently expected to come in at 2.8% year over year. With Fed fund futures still pricing in a cut in November, and the fear and greed index still in the neutral zone at 47. And typically markets will bottom in the short term when this hits the fear or extreme fear zone. Hence why I think we could potentially have a bit further to fall on the market, and nothing too interesting happening with corporate insiders either. Also get a bit of a pullback in Chinese securities here, I think setting up for a bit of a dip buy. Same deal with Alibaba and their internet ETF, KWeb. My favorite Tiger Brokers holding up a bit better. Really strong price action across the clean energy space, and it isn't just the States, we've got a bit of weak global equity breadth. See that in Canada's TSX. FTSE also at the 50-day. German DAX falling back. China still holding up the best. Sharp fall in the Nikkei and the Aussie 200 coming back down to support as well, with a sharp dive in the spread of value versus growth stock. But the spread of global economic growth, copper versus gold, still holding up in an uptrend. Credit spreads still holding up. High yield bonds versus treasuries with a bit of a tick back up in inflation expectation. Market really reacting to those bond yields. We can see that in regional banks getting hit hard today, down 2.4%, and REITs as well, looking a bit weak here. Cannabis pulled back into the support zone. My reversal signals indicator firing off a signal today, and we'll be looking for it to find support around the 750 level as a potentially good buy the dip zone here. Let's look at Apple, still hanging around $190 a share. Microsoft consolidating, not too far below all-time highs either. Same deal with Alphabet, Google, still in its technical uptrend, while Tesla still consolidates. And a bit of a pullback overall in financials, seeming to struggle now with these higher bond yields. Okay, so to summarize today, bit of a pullback in the market, gap down and held. Really just Nvidia doing the heavy lifting for the main index here. Like I showed you underneath the hood, looking at the S&P equal weight, we're already in a pullback, a little bit of a correction. And if Nvidia pauses and catches its breath for a moment, S&P 500 I think could pull back below 5200, where we may find support around that 5150, where breadth and sediment should bottom out in the short term, and I expect that to be a bit of a dip buy zone and the market to find its footing. Let's see what this Friday brings us with PCE inflation data. Maybe bond yields are already tracking up, an expectation that could come in a little hot. And for the here and now, stocks are reacting to that. As always, we'll keep it real and follow the tape along with all the other market internals. Thanks very much for tuning in to the Daily Market Review. You're welcome to share your thoughts below this video, and I'll see all you guys again tomorrow night. Cheers.